Hi, my name is Pam Thorne with CMG Home Loans. I've been in real estate for over 20 years, a loan officer for the past nine, and then I've been with CMG the last 2 years. And one of the things that drew me to this company is the multitude of products that we have available for just about every need, and one of those being the all-in-one loan. I wanted to invite Dave Herbst to tell us more. He's our senior program manager. He knows everything about the all-in-one loan. And I'm going to let Dave take it away and just give us kind of the highlights to start with. Dave?
Yeah, Pam, good to be with you. And so the all-in-one loan, like you said, it's obviously very different, but very exciting to talk about as well. It's a proprietary product that we developed back in 2005, and I think a lot of people are typically pretty surprised to hear that because it may be the first time that they're hearing about this loan, but it's not a new program. We started working on it in 2002, and we put it to market in 2005, so it's very well established. And it's unique because of its structure, and I think even more importantly because of what it actually focuses on. If you think about it, most mortgage products were engineered really with eligibility as the focus, so to try to like qualifying aspects. You know what I mean?
Mhm.
Sort of like we sort of squeeze in a mortgage into somebody's life based on what they can qualify for. And I'm not saying that's not important. Of course it is. People typically need to borrow money in order to own real estate. So it's great that we can manage those needs and provide financing. We have a vibrant credit industry. But there's also another component to this, and that is, what it produces, the results. We feel ultimately as a company that the mortgage is not just a mechanism for home ownership, but it's also a participant in financial outcomes. Mortgages have a way of, you know, applying a big, heavy financial burden on somebody's life. They statistically they tend to stick around for much of somebody's adult working life. A lot of people are retiring now or trying to retire while they still owe decades worth of mortgage debt. Mortgages have a way of impeding our progress with savings and buying more real estate and moving up, moving down, moving across town, being more mobile, let alone being able to afford other things. So, we set out to create basically a better mortgage, a more modern mortgage for, today's borrower. And it's up until the launch of this product, we have ultimately only had like one option, and that was traditional financing, as we all know it, the 30-year fix, 15-year fix, very suitable for a lot of the market still today. But most of our market that is active in real estate are not first-time home buyers like they were back in 1938 when the 30-year term loan was developed. A lot of our people that are active in real estate, need more help. They need a financial cut in line. They need faster payoff. They need to spend less money on mortgage interest. They prefer to have liquidity, and meaning access to equity money if they need it. And so we built this product to do those things. And it's a really exciting product for people because it's refreshing. If you have to borrow money and go into debt long term, it provides everything that somebody would actually want: reduced interest, fewer payments, lower payments without relying on interest rates or changing your budget, access to equity money 24/7 without refinancing. So it's a phenomenal product. I can obviously go into structure and the terms of their product, but I think it's really important to point out like why we developed it, why we offer it, because I think the why is the most important part of it all.
For sure. And this basically, in a nutshell, this is a loan. It's a mortgage loan. It's a HELOC, and it's a checking account with an ATM card. So
That's
it
right.
provides all of that. And like you said, gives you the option to it basically turns your house into a bank. Is that a good explanation?
Yeah, it's sort of so what we've done is we've merged a mortgage security, which is a first lien position line of credit. Lines of credit are great, like a HELOC, but we refer to it as a line of credit because the traditional sense of a HELOC is, well known. They are typically in second lien position. They only allow, limited draw access, typically 5 or 10 years. This one allows up to 30 years of access. And for primary residences in Texas, as you know, we allow up to 25 years worth of access. So it's open-ended, meaning you can apply money towards it, take money out of it whenever you want, 24/7 without being penalized. So you get to control your balance in your use of equity money over the entire term of the loan. That provides a lot of freedom, financial freedom to do, a lot of different things. But also it creates an incentive to apply more than you normally would towards a mortgage because your money, you don't lock up your money in mortgage prison. You get to access your money anytime you want. So it's a first lien position, line of credit. But to your point, it comes with a merged checking account, personal checking account merged into the loan. And the idea here is to create a relationship between the dollars that we earn and the dollars that we owe. So we can use the dollars we earn to automatically offset the cost of dollars we owe on our house. And that's done really easily through the loan. When a customer deposits money into the all-in-one loan checking account, those dollars can be applied directly to loan principal. And so the customer has an opportunity here to apply money to principal and make the mortgage the storage place for idle money before they need to spend it tomorrow or this coming weekend or whatever it may be. And the benefit here is that money applied to daily principal offsets daily and monthly interest costs. And by a lot, not just by a couple bucks. People save hundreds of dollars per month, thousands of dollars per year. And when you pay less interest on a mortgage, guess what happens? You pay off faster. You build equity faster. You retain more of your income. I mean, I think that's one of the coolest benefits of the product is how would you like to retain tens of thousands of dollars more of your own money and not spend it with a lender?
And that's something different too about this program is I've talked to people about it and they notice the interest rate is a little bit higher than the standard interest rate. But can you explain a little bit about the whole idea that with this product, it's not necessarily the rate you pay, it's the amount you pay over time and why you save so much with the all-in-one versus a 30-year fix that might come with a lower rate?
That's right. And I think you said it beautifully. That's one of the most important questions that we can ask and because it illuminates the core issue. When people are seeking the lowest rate on a loan, which they should, what they're really seeking is the lowest dollars they have to spend, right? That's so we use the interest rate as the measuring stick, as the lever to be able to do that. However, that's not the most direct path in reducing your costs. So if people are interested in just simply spending less or fewer dollars towards a loan in total, the most direct way to do that is to reduce what's owed fast, right? So when you delay pay down of any debt, it's going to cost you more, even with a low rate. Low rate loans cost high amounts of money. So if we can actually reduce the principal balance faster, the daily principal balance in which we're computing interest on, then we can help people reduce the amount they're going to be charged. And so the way we do that is just by applying money directly to loan principal before interest is even computed. It's exact opposite of all traditional financing, which is amortized, which loads in the interest up front. This doesn't do that. Principal paid first, interest computed only after the daily balance is reduced. How do you reduce
And
your
it's
balance? Yeah.
simple interest,
Simple
right?
interest. That's right. Yeah. Simple interest recalculating nightly
Yeah.
automatically. Just the rate divided by the number of days in the year, so 365, gives us a daily rate. And that daily rate is just multiplied to the or by the loan balance at the end of the night, each night. And that produces lower daily and monthly interest cost automatically for the customer. So there's no amortization schedule. The amortization is the most expensive part of a mortgage. And
Mhm.
we replace that with life's greatest financial resource, which is income. And what manages our income. Where do we place our income to manage it? Checking account. That's the beauty of the all-in-one loan, which is why we call it the all-in-one loan too. Is the merging of these two everyday normal things together, creates the opportunity to use money that you've earned through a mechanism you already know how to use to offset costs, on a debt that people have already committed to. So very, very easy to use, and
Yeah.
the benefits are automatic.
And then how could you explain, because I know in Texas with our primary homes, we set it up a little bit differently than we do in the rest of the country. And then also in Texas, that would just be pertaining to primary loans. So if you have a second home in Texas or an investment home, it would be set up similarly to most of the rest of the country. Can you
That's
touch
right.
on that, just explaining the difference?
Yeah, yeah, absolutely. So the way to think about the all-in-one loan product is we have two product categories, really three if you throw in our construction all-in-one loan or one-time close construction for custom home. Not yet available in Texas, but coming, Pam, I promise. But ultimately, there's two primary categories of the product. One is what we call our standard all-in-one loan, and the standard all-in-one loan would apply to primary residences, investment properties, and second homes in all states except Texas. The standard would also apply, though, in Texas to second homes and investment properties. And the standard all-in-one loan is a 30-year draw, first lien position line of credit. And the checking account has what's called a sweep function to it. And what that means is all deposits, 100% of deposited money, whether you deposit a dollar or $100,000 today, 100% of those dollars will not be allowed to reside in the checking account, earning what, 0%, what is typical of a checking account. But instead, it sweeps those dollars or transfers them automatically to the line of credit, paying down the principal automatically. So that's the standard all-in-one loan. And again, 100% of the deposits move to the line of credit to pay down principal. So this is the only principal paid first mortgage in America, which is awesome.
Mhm.
And then there, the dollars are free to use. Comes with ATM debit, Visa cards, check writing, online banking, bill pay, ACH transferring, wire transfers domestically, internationally. It's a checking account, and the customer doesn't have to move money manually, from in between the two
Yeah.
accounts. You just spend money like normal. Now, the Texas Homestead version is our second category, the Texas Homestead or TXHS. Homestead, obviously meaning primary residence in Texas, and that's slightly different to comply with Texas laws because you're unique down there. You have some unique
Yeah.
laws, and so to comply, it's actually a 25-year accessible line of credit, still first lien position, of course, but it allows just for 25 years with the draw access. One of the other items that's different is that it won't sweep all the money that is deposited. Instead, there's no law that says we can't apply the sweep function. But there is a law down there that says dollars spent out of a line of credit or really any mortgage, equity dollars spent back out of a mortgage have to be at a minimum of $4,000 per advance. And so, like if you were to go get a 30-year fix and do a cash out refinance, you'd have to cash out a minimum of $4,000. Well, because this is a line of credit, that really matters because, as you utilize it over time, you might draw out money today, you might draw out money this Saturday. Well, Texas state law requires each individual draw is a minimum of $4,000. Well, so to comply with that and not force somebody to take out $4,000 out of their line of credit just to go grocery shopping, unless you got a big family, that might make sense. But ultimately, so we cut off the sweep. We basically just eliminated the sweep on the Texas Homestead version, so that the customer, so that every single one of your borrowers, has complete control of how much money is going to move to the line of credit to pay down the principal or not. So this is the way it works. If I lived in Texas and I had an all-in-one loan applied to my primary residence and I got paid today, say I got paid $10,000 or something, but I had some near-term bills and expenses that I needed some money for readily available, right? Maybe that's $1,000 for the week that I needed. So I could, get paid today and later today decide, oh, I don't need 9,000 of this. I'm going to just go into the mobile app and transfer $9,000 from my all-in-one loan checking account to my all-in-one loan mortgage. And that's same day transfer. Boom, my mortgage balance goes down by $9,000 today. And that keeps the other $1,000 in my all-in-one loan checking account for, things I need to spend money on this week. That way I'm not forced to pull $4,000 out that I don't necessarily need all those dollars, in the near term.
Sure.
So that's the primary differences between the two. The customer's in greater control, I would say, with the Texas Homestead one versus the standard where all of the money automatically goes. And you know what we found, Pam, is that people down there have actually, they prefer the Texas Homestead version. They prefer the total control of every penny
Mhm.
they have versus, the automatic sweep. So, but yeah, those are the differences just to comply, and they're both available for all occupancy types.
Okay. And can you talk a little bit about, we've got the AIO simulator, which is a great tool that we have online that we can share with our clients who are considering this product. Can you share a little bit about how that works? And
Yeah.
just the amazing thing is every time I run it for somebody, it is such a stark contrast in terms of how much faster they pay off their home loan. Obviously, they still have access to all that equity, which is the big perk.
Mhm.
But then the fact that the interest they pay is a fraction of what they would pay in a 30-year fix. Like you were
Totally.
discussing, it's weighted heavily on a 30-year fix. You're paying all that interest up front. With the all-in-one, we have the exact opposite situation.
Exact opposite. I mean, again, said perfectly. The reality is that most people already possess all the money, all the resources they need, and actually all the skill set they need to make greater financial progress in their life. It's just that the tools that we have been using, especially in finance, especially related to debt management, have not been innovated. They haven't. The traditional mortgage was put to market by FHA in 1938 to help, stimulate the economy. And one way that was important, or that they could do that back then, coming out of the Great Depression era, was simply to try to convert, America's renters into homeowners. So really the 30-year loan and the amortized loan, as we know it today, commonly used still, was put out there. And, ultimately that just delayed payoff. That's what it did. But delaying the payoff also reduced the monthly payment. Because prior to that, all America had access to were like 5-year balloon payment loans or 7-year balloon payment loans, very unaffordable, and also 50% down payment requirements. So, really, it was really challenging to be a homeowner back then, own real
For
estate.
sure.
So obviously the 30-year loan and the common mortgage, helped ignite, stimulate the economy, and certainly did its job. First-time home buyers were able to get into homes, and especially post World War II, the GI Bill and veterans coming back, be able to buy their home, and it helped create a middle class boon. I mean, for sure, it helped build America. But the flip side of that is that we live in 2026 now. First-time home buyers are only about 21% of the overall home sales on an annualized basis, but we're still delivering everybody products that were only developed for first-time home buyers. It's an odd thing if you think about it. If you take a step back and go, gosh, the mortgage industry is sort of behind with innovating things. You can turn on your oven from a mobile app in your car 2 miles from being at home today. You know what I mean?
That's true.
You,
Yep.
you know, you can engage neighbors through, or somebody at your doorstep through your doorbell. Yet the mortgage hasn't changed since, 90 years ago. The all-in-one loan represents simply an innovation, and it's purely consumer driven. I would say it's the only mortgage product available that puts the consumer ahead of the banks, ahead of the lending, institution. So principal paid first means that it rapidly reduces what's owed and the amount of time somebody's going to owe it. It's a direct solution
Mhm.
to borrowing money and owing money. In fact, to your point too, the simulator captures that in contrast that potential benefit to traditional financing. And as you know, if this loan does not produce a benefit, if as forecasted through our interactive simulator, just an easy to use calculator online, if there's not a stark and obvious benefit, we just will not put this loan in place for someone. It's we want to see an enormous interest savings, and I know you can attest to this. The interest savings we see is typically in the hundreds of thousands of dollars worth. You know what I
Yeah,
mean? It's like you
exactly.
you buy a home for $400,000 today. Call it. Let's just use $400,000. At 6% repaid over 30 years. 6% is a relatively decent rate, right? It is. That's been about the average rate over the last 35 years for traditional
Yes.
financing. So it's an okay rate. It's not 3%, but it's not 9% or 8% either, right? So that rate will cost somebody $116,000 in interest for every $100,000 they borrow. So they're going to end up, repaying close to $1 million for that property. And that's
Yeah.
that's just insane. Principal paid first means that we can reduce so much interest that it's like getting a traditional loan with a rate well below 3% today. Oftentimes, the contrast is you'd have to go get about a 2% 30-year loan to pick up the same savings benefits that the all-in-one loan produces without having to wait for rates to come down to 2%, because we may never see that. We just may
Yeah.
never see that. So, this is, like you said, less reliant on the rate, more priority is placed on principal reduction and time reduction, and doing it with money that people already have in their possession, the money they earn, and with their income checks and stuff. So yeah, it's set it, forget it sort of thing, and spend as normal. You no longer have a
Yeah.
traditional mortgage payment, and it just goes to work for you.
And I think one thing that's awesome too is that even when you've paid off your loan completely, so you have a zero balance, you're being charged zero interest, you still have access to the credit line on your house for the full, well, it's 25 years in Texas. but the total amount gets reduced starting, I think, the 11th year. Is that correct?
That's right. Month 121
So
exactly
it's a small amount. It's like 1/240th per
of the
month. So it's
total.
not
Yeah,
a large. So you, for the most part, have access to a huge chunk in your house that you can borrow. If you have a child getting married, I know how expensive that is, or you have kids going to college, or you just want to do home remodeling, you would be able to access this, even if your loan's already paid off.
that's right. Yeah, I
So
mean,
that's amazing.
at year 20, you still have 50% of the line of credit still available. So if we approved a $400,000 all-in-one loan, that means we approved a $400,000 line of credit.
Hmm.
And 20 years into it, you'd still have $200,000 of credit available. Hasn't gone anywhere, even if you paid off your home 10 times up until that
Yeah,
point. That's how people utilize this. They use it to pay down and pay off fast, and then, just write a check because you want to put an ADU in your backyard. You want to remodel the kitchen or expand your house, or
sure.
you gotta start supplementing some tuition costs for children to go to college. That's fine. It's your money. And I think back to your original comment where this does allow you to actually function as your own bank. You know what I mean?
Mhm.
That you become the bank of you in a sense.
So, who would this not be for? Because I know we talk about it. It's not something I share with every single client I talk to. I would say it's probably for the vast majority, but who would it specifically not be for? Or maybe if it's easier to explain who it's for.
Now that we've kind of exposed the benefits and how it works, it's really driven by income being driven into the loan, so they can offset daily principal in which we compute interest on monthly interest payments on. So if you have good cash flow management skills, behavior, then it's a really good product for people, a very powerful product. Most people will earn more money in just 5 years than their mortgage balance. So think about that.
Crazy.
More money will flow through a checking account for a individual household in just 5 years than the
Mhm.
amount that they owe on their house for a mortgage balance. Just all we're doing is we're just coupling the two together, where you store your cash, and where the debt is managed, and instead just streamlining the process, and so you can also tell by that description though that households that don't have a grip on their spending, really are, I'd say, credit heavy. They really need to utilize credit cards to just get by on a monthly
Yeah.
basis. And that's it's unfortunate. A lot of people still, they're in that period of their life where something happened, and that's the risk is that their balance would just go the opposite direction, go up, right? And we don't want to see that. That might be a household that's much more suitable for just the standard, traditional financing where it's scheduled repayments, over a lengthy period of time. That does give some more predictability, I guess, in terms of payment. Our loan, though, for cash flow positive households, drives the principal down so rapidly, and that actually recasts monthly payments. So the minimum payment on our loan is just the interest, because anything left in it has already gone to principal. So imagine your payment reducing automatically for you. This gets easier and easier and easier for people to pay because it
Hmm.
gets more affordable. Your interest costs go down and down and down automatically each month, so long as you're leaving more in it than you took out. So I would say, the households that don't make sense are those that are living, pretty much close to paycheck, or sometimes, we also want to do our diligence up front and make sure that a borrower doesn't necessarily change their spending habits once they get into it, and suddenly go, my gosh, I'm liquid. I'm gonna go buy that boat, and start doing a bunch of cool things. You can go do that. You're liquid. It's your money. But
Hmm.
the risk is that the balance goes the opposite direction, and that interest costs go up, payments go up and such. And we just don't want to see that happen to people if they can't afford it.
I think it's worth mentioning too that with this product, we have not had any foreclosures. Nobody
That's right.
has, this man in how many years?
Well,
23
yeah,
years?
21 years now. That's right.
It's crazy.
It
That's
is.
crazy. So that's
Yeah.
something really unique because we can't say that about the typical mortgage.
No, it's
So,
safe. Yeah, it's a safer way to do it. Like, again, you're liquid. I think you pointed that out a minute ago. It's really key. Your money remains available. So even if you fall into hard times, we've gone through COVID. We went through the 2008 financial
yeah.
crisis. People did lose their job. All of well-known customers lost their jobs, or during COVID were self-employed and weren't able to earn income, generate income. but because it's a line of credit, you can fall back on it, and
Right. To pay
that
your
obviously
interest. That's
totally,
all
that's
you
right.
need to pay is the
That's
interest.
right. That's right. And it does it automatically too, right? So it's very hard to go late on the product. It sort of delays the threat of foreclosure or defaulting when times are challenging for that fact. It always just allows people enough time to get back on their feet and get through a challenging period of time and get going again
Yeah.
without being so worried about losing their house.
Well, thank you so much. I think you've covered so many great things about this loan. I'm sold. If I hadn't heard about it, just hearing what you've had to say, I can't imagine why I would ever want a 30-year fixed mortgage. Again, it's not necessarily for everybody, but certainly the vast majority of people could benefit from this. Thank you, everyone, for listening. And if you have any questions, I'm here. Feel free to call me. My number will be at the end. And Dave, thank you so much for your time today.
You're welcome, Pam. Good to see you.